Hey guys, welcome back to my channel. I'm Michaela from My Property Accountant, and today we're going to be talking about the 7 reasons why a serviced accommodation is the best UK tax strategy for residential accommodation. So I made a post the other day on LinkedIn about this, and I got a lot of calls of people interested because they said their accountant had never spoken about some of these strategies before. So I thought I'd just make a quick video about it. So a lot of people get into serviced accommodation because they realize they can 2 to 3x their income compared to a normal buy-to-let property, but then they actually don't realize, or they realize afterwards, that this is actually a fantastic tax strategy. There's so many tax benefits that you can't get with buy-to-let properties. So let's get into them. The first benefit is that you can deduct your full mortgage interest cost against your income if you have a furnished holiday let or serviced accommodation, if it meets the criteria. I'm not going to go over the criteria today, but just know that. And if you have a normal buy-to-let that is in your own name, you cannot deduct the full mortgage interest. And a lot of you will know this as Section 24. And yes, you can get a 20% tax credit. But if you're in the 40% or 45% tax bracket, you're actually really losing out. If you have a really big portfolio, you're probably losing out. And there's a lot of landlords that are now shipping their properties into a limited company when they could actually maybe just turn their properties into serviced accommodation, and they would avoid this hassle. So we're going to go into a bit of an example to explain more about this. Right, so we have our example. So I've just chosen this little place in Earl's Court. Whenever I think of Earl's Court, I always think of Diana because she apparently lived there when she met Charles. And I know what you're thinking, £515 for a 1-bedroom apartment. Isn't that crazy? And you can leave a comment below about how angry you are about it. I'm also angry because I don't live too far from here, so feel sorry for me. This would be your mortgage interest, except I'm going to change a few numbers here. I'm going to make it about 6%. You wouldn't really pay a 10% deposit. You're going to pay about a 25% deposit. 128,750. So you're going to be charged interest about £2,489. I would say a 1-bed property in this type of area would get about 2,200 rent. So now you're already off to a bad start. You're making a loss, but HMRC doesn't think you're making a loss. They think you are only earning 2,200. So they won't recognize this £2,489 as a deduction. So what we're looking at here is if the property was bought as a buy-to-let property or if it was bought as a serviced accommodation. So we're going to say that we're earning the same amount of money. I know you're going to be earning more money if it was an Airbnb, but let's just go with this example to compare like to like what the tax treatment would be. So what you'll see is that you don't actually get a mortgage interest deduction. So you're missing out on £2,489. So that means your taxable income for your buy-to-let property is 2,200, whereas you're making basically a tax loss in HMRC's eyes for serviced accommodation of £289. So you can use that against another property, or you can bring that loss forward, which is really great. So you will get a tax credit of £498 for the mortgage interest, which is only 20% of the mortgage interest. But if you are a 40% or 45% taxpayer, that's going to be an issue for you, and you're going to be paying too much tax. Now in this example, I'm just ignoring other costs, just purely looking at the basics here. I know we'd have other costs, but those costs are mostly tax deductible for both, so it doesn't really matter. So you'll have a tax payable of £382 per month. So if you had an Airbnb property, you'd have an annual saving of £4,586, and this is just for one property. So I just want to show you how bad this can actually be for landlords in the situation. Here's a P&L of what actually happens. Can also be looked at as the cash flows. You'll see that they're actually making a loss in both situations before tax, but at least with the service accommodation, you're not paying more tax. If you're making a loss, HMRC isn't recognizing you as making a loss. So now you have to pay even more money on top of your loss. So I really understand why there are landlords who are setting up shop or who are selling their properties, and why they're trying to get them into limited companies, but this is definitely an alternative. So now the second reason why service accommodation and Airbnb hosting is such a great tool is because you can claim capital allowances, and you can't claim capital allowances on a normal buy-to-let property. Capital allowances are my favorite topic. They're my favorite thing to talk about because you can essentially pay 0% tax for a few years if you qualify for them. I'll explain a bit about capital allowances. It sounds like a scary word, but it really isn't. So basically it would be, we'll say, like a deduction for anything that you use longer than 12 months. That is a simplified version. The accounting gods are going to kill me for saying that, but that's basically what a capital allowance is. And usually it's a bit like depreciation. So usually you'll expense it over the life of the asset. So just say you have a table and you think that the life of the table is about 5 years, you can expense it over the 5 years in equal installments. That's what depreciation is. The government has been quite generous, and instead of expensing this asset over the 5 years, we get a capital allowance, and it's called a first year allowance, and we can expense it all in one go in the first year up to £200,000. So essentially you can get £200,000 tax free per annum if you have that many capital allowances. Now let me explain what types of capital allowances you can get in a furnished holiday let or service accommodation or Airbnb. So firstly, there are embedded allowances. So those are things that you can't really see. They might be things in the walls like insulation and pipes and boilers and that sort of thing. And usually if you buy a property second hand, you'll need a specialist and you'll need a valuation, and they'll actually come to your property and value all these things. So you need to have that done really to get these capital allowances. So the other type of capital allowances are things such as furniture or refurbishments that you are able to expense in the first year. So that's great. That's usually a bit more straightforward, and your accountant can do that, and you wouldn't need a special evaluation for that. But the bulk of the value of the capital allowance actually comes from that valuer. You can expect to get a capital allowance equal to about 20% of the property value. It's a rough estimate, but it can be useful. So if the property is kitted out to the nines, it's closer to a 5-star hotel, and you really have made it very bougie, you'll get a higher capital allowance. If it's just kind of a standard house and you've done a basic renovation, it will get a lower capital allowance. So we're going to go through a quick example, still hanging on to the Earls Court property, to show you just how this works. So I had a look at some similar Airbnb properties in Earls Court and looked at a comparable one double bed for 2 guests in the area. There's a range of prices, but I found that something with a living room is probably about £200. Let me show you the figures. So with a property value of £515 and a 20% capital allowance, we get to £103,000 that can be offset as the capital allowance. So as I said, you can't claim that whole amount in 1 year, so you're gonna be able to bring it as a loss going forward. Now if we assume a nightly rate of £200 and I've set a 75% occupancy, that would give us an income of £4,400 per month. We'll have a mortgage expense of £2,489, which we discussed earlier. That gives us the annual taxable profit of £22,932. So what you'll see is the capital allowance is a lot more than your taxable profit. What happens is you create a massive tax loss in your business in this year, equivalent to £80,068, which you can then take forward to the next year. So you don't pay tax in the first year, but wait. And then you don't pay tax in the second year, or the third year, or the fourth year. And only in the 5th year do you actually pay tax. So you can see this taxable loss is just being carried forward. It's being offset by your taxable profit, and you're just carrying forward that loss year over year, you're not paying tax. Until the 5th year, you finally use your whole capital allowance. And just say, in this example, you're 40% tax payer, you're still only paying 20% tax in the final 5th year. So you're still even using that in the 5th year. So really 4.5 years of tax-free profits. It's really great. So now, if you are making more of a profit, you'll use that quicker and you'll have less years of tax-free income. If you're making less of a profit, you can really stretch it out and have a few years of tax-free profits. So the third reason why service accommodation is such a good tax strategy is if you sell the property, you're going to have a chance to reduce your CGT. Now, CGT normally is 18% for a basic rate taxpayer and 28% for a high rate taxpayer. And you can actually bring this down to 0. So I'm going to talk about the 2 strategies now. The first strategy is entrepreneur's relief, where you can actually just pay 10% instead of that 18 or 28%. So this is a bit of a more difficult one to get. Your service accommodation will have to be providing services a bit like a B&B or a hotel. So things like cooked breakfasts and laundry and daily cleaning, providing extra facilities, whatever you can think of, those would be the extra services. There isn't a hard and fast rule, but the more you have, the more likely you are to get this relief. If that is you and you are providing some additional services, you can maybe claim that 10%. So the second one is even better. You can get a whole 0% of capital gains tax, or your capital gains tax is essentially delayed. And what it requires you to do is buy an asset within the next 12 months. Now, it has to be equivalent to whatever you sold your previous asset for, and the asset doesn't have to be property or service accommodation property. It can be any type of business asset. So you could buy a restaurant or you can buy another company, or whatever your heart desires that is considered another business asset. So the fourth great thing about service accommodation is that you're allowed to split the income between parties that own the property. So for example, a normal case that happens on a daily basis that I see is that a wife and a husband own a property. So usually in a buy-to-let you have to split the income 50-50. There's a problem with that because just say the husband has a job and he actually doesn't really manage the Airbnb property. The wife is actually managing the day-to-day runnings of the property and he's not involved at all, but he has a 50-50 share, so that property income needs to go 50% on his tax return. The problem though is that maybe he has a job and he's a 40% taxpayer and he's already used his personal allowance, but his wife has not used her personal allowance and thereby hasn't used her 20% tax bracket either. It will be more beneficial if all the income goes to her name, and in an idealistic world all the income would go to her because she's doing most of the work. And in a buy-to-let scenario you can't do that. Airbnb property, you can split the income differently to show the true reflection of the operations of the business. So let's look at an example how this would actually benefit the couple. So we've taken the same example as before. This property is owned 50-50 and it's getting a taxable profit of £22,932. Now this has to be split 50-50 between the couple. They each have a profit of £11,466 on their tax return, but the husband has already used his personal allowance, so he's now going to be taxed at a whole 40%. So he's being taxed £4,586. The wife has just used her personal allowance. She's still in the 0% tax bracket, which is great. But we prefer the second scenario. So as you can see with the service accommodation, if she's doing all the work, all the income can go to her, and then she's able to use her allowance, and then she falls into the 20% tax bracket. For the remaining amount, she will pay a tax of £2,072, and overall the scenario will get them a tax saving of £2,514 on top of all the other tax saving tips I told you about before. So now the fifth reason why service accommodation is really great is for your pension. So this is a really great one, and I know one that's a bit overlooked or people don't fully appreciate, but you will appreciate it one day. And this is because your earnings is classed as net relative earnings for the purpose of your pension, and this just isn't the case for your buy-to-let income. The sixth advantage of service accommodation is to do with the rent a room scheme. So if you rent a room out in your main residence, and there's a few different criteria for this, you can get a tax credit of $7,500 against the income coming in from that room. So there's a few criteria to do this. It has to be your main residence and it has to be connected to your house. You have to use the same entrance, so it can't be a side building, it can't be an outbuilding, or it can't be a cottage in your back garden. It has to be attached to your main entrance and you have to use the same entrance. So that's if you qualify. So they've made it a bit more strict now. You also have to be in the house while the lodger is using that room. So you can't use it for when you're overseas. You'll have to apportion that credit. So yeah, that's a really great one. Like $7,500 is a really great amount and a huge tax saving. And it's just to note, you can either use that or you can claim the actual expenses. And I don't know a situation where the actual expenses would really outweigh $7,500. It would probably be really hard to get to that amount. So I think the $7,500 is quite a generous offer. So the seventh reason why it is actually better to have service accommodation is because it's more advantageous to have property in your own name than it is to have in a limited company. Now, I'm not saying that you should only buy your service accommodation in your own name, but I'm saying so it's okay that you have it in your own name, because if you are doing serviced accommodation, it is actually more advantageous and you don't have to rush out and convert all your properties to a limited company, which can be really expensive. It can be quite a big hassle and it's quite difficult to actually qualify. And maybe even the first 1 or 2 service accommodations that you get, maybe it will be beneficial to have it in your own name. And the reason for this is back to our second example, which is because of the capital allowances. If you're able to use capital allowances to pay 0% tax, then if you have it in your own name, you will still pay 0% tax. So if you have the same situation with capital allowances in a limited company, you won't pay corporation tax for a few years. The exact same scenario will occur, but the problem is to actually access those funds, you are going to have to pay dividend tax on top of your corporation tax. The current dividend rates are 8.75% for a basic rate taxpayer and 33.75% for a higher rate taxpayer. So that's quite a bit of tax that you have to pay. And if you had your properties in your own name, you wouldn't have to pay that. I'm going to make a more detailed video about this, comparing the pros and cons of having serviced accommodation and Airbnb property in your own name or in a business. And there are a lot of things to consider. I wouldn't say this is the only one, because this is quite a short-sighted plan, and for the short term it's great, but for the long term it might not be the best option. But it's just to give you a bit of reassurance that it's okay that your properties are in your own name if you have already purchased them like that. But I would first speak to your accountant before I ever bought a property, just to make sure you are making the right decision and you know all your options. I have an ebook link below for you specifically on this topic. And also I'll leave my link if you want to book a one-on-one call. We are taking new clients, but if you just want to have a chat and you just want to run things by me, you can book a free call. I really don't mind. It'll just be a quick half an hour and we can have a chat if you ain't worried about anything. Thanks guys, bye.